Hello and welcome to Retirement Today. My name is Jenna Cairns from Beacon Wealth Advisory. If you'd like to get more information about what you hear on our show today, you can give us a call at 1-800-994-8993, or you can go out to our website at beaconwealthadvisory.com. And we're here to get you to and through retirement with financial peace. We also invite you to listen to our past shows on YouTube. We've got a YouTube channel now that you can go out and type in Beacon Wealth Advisory and subscribe to our videos, and then it'll notify you when we have a new one out each time. Or you can even go out to Spotify, Apple Music, Amazon Music, a lot of different places that you can listen to our show, or again, watch it by video on YouTube. And so I know, gosh, we did a show not too long ago on the big, beautiful tax bill. But I tell you, I have had more and more questions about how this will affect Social Security. So we're specifically going to go into how it affects Social Security more. But before we get into that, I want to introduce my co-host. A lot of you know her if you've listened to past shows. Jaclyn Gladhill. Always love having you on the show, my friend. Isn't this just great?
It's such a blessing to be here with you, Jenna, and
Oh,
I
thank
look forward
you.
to it every week. I get to be in the radio studio just talking to you, and we have such a good
Oh,
time.
we do. We do. We have so much fun. I love your energy. You're great. So,
Well, I have been hearing all about the Taylor Swift and Travis Kelce
yep.
situation, engagement. So how is
Yes.
Kansas City doing?
Oh my gosh. Everybody is just so excited. And, I'm really hoping I get an invitation to the wedding. I do know people that know people. So it's really going to be the biggest thing that everyone's talking about, I think, for quite a while. And I just think they're the cutest couple. I really do. So it's going to be a lot of fun to just watch them start their life together. And we're excited. And I'll tell you what, I've got a lot of Swifties in the office here. The women that work for me are pretty diehard. So we're actually celebrating the Taylor Swift and Travis Kelce engagement tomorrow. Would you like to know what we're doing?
I would love to know.
Yeah. Now, don't get jealous. You might want to come work for me after you hear this. But we are taking the morning to have a fun team event, and we're going to this place called the Ultimate Escape Day Spa.
Is it in Kansas City?
Yes, it is it's kind of in Leawood, which is like a suburb of Kansas
Okay.
City. So we're getting facials, massages, body wraps, everything to just, celebrate this engagement and
Yeah.
just having a great start to the year together.
Yeah, and I know you guys have been doing fantastic at your business, and so it's also
Thank
just,
you.
a celebration for all your employees to get
That
together and
is.
bond
Yes, yes.
and what
That's
a
actually the main reason we're doing it, but we are also going to celebrate the engagement.
yes. I mean, what a boss girl way to celebrate, right?
I know. It's going to be fun. So,
Well, and
yep.
Labor Day is this weekend. So, do you have any plans or what are you up to for Labor Day?
Yeah, we've got some fun plans. I think I mentioned on the past show, I've got a daughter that really probably will be a professional soccer player. She absolutely loves soccer and is good at it. So we're taking all of them to that Kansas City Current soccer game this weekend.
Wow.
We've all got matching Kansas City Current shirts, and we're going to take some pictures and probably post it on Facebook, have some fun. And then we're going to a pool party on Labor Day. So it's going to be a really fun weekend. And it's supposed to be not blazing hot here this weekend, Jaclyn.
Mhm.
So how about you, though? What are you doing?
Well, we have the Minnesota State Fair going on.
Yes.
And so my boyfriend and I went last weekend,
Yeah.
and it was such a blast. I mean, I had to recover for a few days with all the junk food I ate. But I
Love
think
it.
this weekend we'll try to go again with my parents or family or different people. We only get 10 days a year, so got to make up for it, right?
Yes. I remember you said you were going. And so I love that. What kind of junk food did we have?
Oh, so many. We actually went early in the morning And I did stand in line for an hour and 45 minutes for Amish donuts.
Oh, that sounds
And
really good.
they were delicious. They are the top food at the state fair. And so the lines are crazy. And I will tell you though, as soon as I turned around, I got my box, turned around, and a lady goes, "How much for a donut?" So I made $10 for one donut that I
Oh
gave to
my
her.
gosh, that's
And
great.
so I was like, it was worth it. It was worth it.
Yes. Oh my goodness. That's wonderful. Yeah. Well, that sounds really good. I think I told you I had the best cheese curds of my life at the Minnesota State Fair. So, did you happen to
Yes.
get any cheese curds in or onion
Yes.
rings or anything?
The mouth trap. Have you heard of the
Yeah?
mouth? Yep.
No?
We got cheese curds from them. They're like the big cheese curd place
Oh,
at the state fair. And
got it.
but just lots of funky foods, which is always fun for me. I don't go the typical food route. I get all the weird ones.
Love
But
it.
I mean, Jenna, so I know we've done a show about the big, beautiful tax bill, but today we're going to be focusing more on the impacts it has on Social Security, right?
Yes. Yes, we sure are. Yeah.
And
And
this is like a hot off the presses show today.
it really is. And most of the information I'm sharing with you is from a USA Today article, which talks about Social Security and the tax breaks, what the big, beautiful bill really means for 88% of retirees. And I think that article really made some good points. So I wanted to share it. But I do want to share with our viewers and listeners today that I'm going to stay away from the politics of it all, because I know when people talk about this big, beautiful tax bill, they kind of lean one way or the other. And there's really some strong opinions, don't you think, Jaclyn, on both sides on whether or not this is a good bill or not?
Yes, absolutely. And biases for sure, too.
Yeah, there is. So for those of you listening, I am just going to take a neutral, share the facts with you approach today. I'll let you decide what your political viewpoint is, but I do think there's some information in here from this new bill that could really help a lot of people, especially when they're doing their tax planning, right?
Absolutely.
Yep. And so let's look deeper into that claim that 88% of people receiving Social Security, really won't have to pay taxes. That 88% figure was touted by a Council of Economic Advisors. And one of the big talking points, again, is that 88% of Social Security recipients would not have to pay any federal Social Security benefits or a lot less. Social Security tax. And while that sounds great, it is important to understand the full picture. There isn't a jump from 0 to 88% right now. About 64% of seniors already don't pay federal tax on their Social Security benefits. That's basically the case because of existing deductions and income thresholds. The current proposal would increase the number, though, to 88%, mainly by introducing another deduction. And we'll talk about who qualifies and what portion of the Social Security tax could maybe bring it down to 0 or reduce it. But it really is important for our listeners to understand it is not a total elimination of taxes on these benefits. Jaclyn, I don't know if you've heard in the news that, said that Social Security is no longer taxed, but I know I have heard that and it's not accurate, right?
Yeah, a lot of inaccurate information that's
Yeah,
going around.
I know. Right. However, that senior deduction that's out for people over 65 is $6,000 per person. We'll go into more about that, but that deduction is set to expire in 2028. So unless it's made permanent, we could see the percentage that seniors pay tax on benefits change in the future, obviously. So, and that applies just to federal taxes. You do know, Jaclyn, I'm sure you know this, that there are some states that also tax Social Security at the state level, right?
Absolutely.
The good news is, in most cases, those state levels are not permanent. And there are states that are even, depending on income, they don't tax you. And some states are even looking at changing that. So if you're unsure how these changes will affect your loved ones, or maybe you are over the age of 65 and want to know more about that $6,000 senior deduction. It's really important that you have a financial advisor that keeps you up to date on these things that could greatly impact your financial future. And of course, your CPA. It's really our job to help make sure you're informed and that you can make good decisions on the future. Would you like to know what the 9 states are
I would
that
love to
tax
know. Yeah, what
Social
are the 9
Security
states that tax Social Security, Jenna?
at the state level? Yep. Now everybody's taxed at the federal level, excuse me, as far as states go, but there are 9 states that do still tax it at the state level. Colorado, Connecticut, your state, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont, and actually West Virginia. So, that's
Wow.
a lot of states. Now, I will tell you, Kansas used to be on that list, and we may want to get some wine glasses out and kind of toast to this, Jaclyn. I don't know if you have a sound effect or something you can turn on, but it's like, Republicans and Democrats actually came together to pass a law that Kansas no longer will tax Social Security recipients at the state level. Isn't that great?
Wow. I mean,
Yep.
full world moment there, right?
I
Everyone's
know.
coming
Yeah.
together for one conclusion finally.
I know. Yeah. Our state capital is in Topeka. And, I get all the emails about what's going on politically and everything at the state level. And I was just thrilled to see that they came together on that. And that's going to change a lot of people's financial situation in the state of Kansas. I mean, that's a big deal not to be taxed anymore at the state level on Social Security, right?
Yeah. So can you go into further depth on these states and maybe explain more what's going on?
Yeah. Well, it might cause a little bit of these states, to make some changes. Like I say, some of them are talking about it. But, if you look at Connecticut, for example, if you're a single filer or married filing separated, your adjusted gross income, if it's under 75,000, your Social Security benefits aren't taxed. If you're married and filing jointly, then it applies to your AGI, and you won't be taxed if you're below 100,000. Other states like Minnesota, your state, New Mexico, Rhode Island, and Vermont also do have some exemptions. The thresholds are different in each state, but the pattern is similar. If you fall below a certain level, you might owe not as much state tax, or some not at all. So there's some potential encouragement out there that some of these states, if you're under a certain level, won't tax you at the state level. So that's good, right?
Yeah, no kidding.
So I mean, as you can see, Jaclyn, it really makes sense to stay on the cutting edge, right, of these taxes and Social Security changes, right?
Yeah, I mean, Jenna, it's great that you are on the cutting edge of taxes and Social Security because I know you're able to run a Social Security analysis to help show people how to maximize their Social Security. How would people get a hold of you to schedule a consultation to talk about this, go through this, and more about their Social Security taxes themselves?
Yeah, thank you, Jaclyn. That was very nice of you. Yeah, we really love doing the Social Security analysis, and we can even talk about the taxation as well as it pertains to it. But people can give us a call at 1-800-994-8993 to schedule a consultation, or they can email us at info@beaconwealthadvisory.com. So, got to make sure you get that analysis, right? So you know the best
Yes.
options.
Yes, for sure. Thank you, Jenna. And I know during today's show so far, we've been discussing the federal budget bill, which is generally being referred to as the big, beautiful bill. Gets a little confusing there. But shortly after the bill was signed into law in July, we did a show breaking it down. But many people are voicing ongoing concerns about kind of what the bill means for Social Security. So we decided to follow up with this episode. So what else do you want to share with us about this, Jenna?
Yeah, again, it's a senior deduction. There's a $6,000 tax deduction that can benefit you on your Social Security taxes as far as federal income tax goes. So if you're 65 or older, that's when it would come into play. And it does have some income thresholds with it. So let's say that you've reached 175,000 or you are at 250,000 as a couple. So Jaclyn, what does this mean in practical terms? Let's just break it down. It means that many retirees could see a little bit of a reduction in their tax burden, especially those with moderate incomes, but it also means the benefit is income sensitive. It's not just a flat deduction. It does depend on income, right?
Yeah, and to me, Jenna, this kind of change highlights why it's so valuable to work with a financial advisor that stays on the cutting edge and stays on top of what is happening with taxes and
Right.
social security. And these numbers aren't just abstract. They could directly affect your income and tax strategies and even your eligibility for other benefits. So if you're wondering how this might apply to your situation for our listeners and viewers, or how to structure your income to take full advantage of opportunities like this, reach out now to a great financial advisor like Jenna.
Oh, thank you. Well, on that note, I'll share my phone number too, 1-800-994-8993. Or you can email us at info@beaconwealthadvisory.com. But thank you, Jaclyn. I appreciate that. Now, all of this, the deduction, the income threshold, the potential tax savings, on the surface, it sounds like good news, especially for those who qualify. And for many retirees, any opportunity to reduce taxes and keep more of their benefits. Don't you think they'd be pretty open to that?
Absolutely.
Yeah. Here's what's important to really zoom in on and remember. We also need to keep an eye on the long-term sustainability of the Social Security system. Right now, according to the article, and we've heard this a lot of different places, Social Security is facing a projected funding shortfall. Potentially by 2034, it's estimated that the program may only be able to cover some of the scheduled benefits if no changes are made. That shortfall is largely due to the fact that we really have more going out in Social Security than we have coming in with incoming revenue from taxes and things like that. So if fewer people, Jaclyn, are paying taxes on their benefits now, this new deduction could accelerate the Social Security shortfall potentially because what people don't always know is that Social Security tax really goes directly into the Social Security trust fund. It's not going into like general government spending. And so, it definitely is helpful for seniors right now with tax breaks and income thresholds. But we do have to keep in mind that we want to protect the long-term sustainability of Social Security as well.
Yeah.
Right.
So, Jenna, why is it possible that the deduction highlighted in the new legislation could affect Social Security's long term financial stability, Jenna?
Well, again, we should note that Congress could change things. They look at it every 2 years, and this means that legislation can change over time. So things in the new budget aren't totally permanent. They could be tweaked or even eliminated in the coming years. But as for your question, an AARP article which it says what we know about the new tax deductions for older adults does provide some useful data. We talked about how the new deduction could lower the tax burden for many retirees. But again, that's just part of the story. Like I mentioned before, there are two specific trust funds, one that supports retirement and survivor benefits, and then one that supports disability benefits for Social Security. In 2024, those taxes brought in around 55.1 billion for Social Security. Now, to put that into perspective, that's about 4% of the program's total revenue, the bulk of which still comes from payroll taxes paid by workers and employers. And while 4% might not sound like a lot, that really could matter when talking about the system overall. The trust fund it could project to face shortfalls, possibly, like I said, as early as 2034, unless changes are made. If that happens and no action is taken, we could see across the board benefit cuts, Jaclyn, of about 19%. Ouch,
Wow.
right?
Wow.
To dig deeper, the retirement trust fund, which is now what serves most retirees, is expected to face the biggest deficit as early as 2033. And according to estimates from the Nonpartisan Committee for a Responsible Federal Budget, some of the provisions in this bill, including the new deduction, could move that up to 2032. Again, this isn't about taking a stance for a bill or a policy, but it is about understanding the moving parts and some of the trade-offs that happen long-term with this decision. And that's why having a strategy that's flexible and responsive is important. Sometimes, Jaclyn, I always say this, but, we plan financially, and a lot of us come up with a plan even for our life, but does life always go as planned?
Absolutely not. I wish it did sometimes.
I know. So that's why, you may have put together one strategy to really maximize your Social Security, but depending on how things go with the funding of Social Security, you may have to pivot a bit down the road and take it earlier, or, just really keep your eye on what's happening with Social Security. I personally, Jaclyn, don't believe that the politicians are just going to let Social Security run out of money. I would think they'd be getting in front of that before, that date. But
Yeah.
that's my stance on it. I know everybody has their own feeling, but again, it is important to have a strategy that's flexible and responsive, right?
Yeah, no kidding. And, just being flexible yourself and being adaptable yourself when things do come up. And, and I know we've discussed a lot about Social Security during the episode or the show today. And there's just been a lot of numbers going out there and
Yeah.
so much information. So Jenna, what are some other things that you want to share?
Yeah, well, we can talk more about, for those that itemize, there was another change to the SALT deduction, the state and local tax exemption.
Mm-hmm.
And now it has a $40,000 cap. It does phase out for higher income earners. So if your taxable income is more than 500,000, that 40,000 starts to shrink. And by 600,000, it could go down to even $10,000. It's important for people to keep in mind that this new cap is also temporary with an expiration date that triggers in 2030. So we're looking at that from a planning window. Again, for those that itemize, especially those who really are in the standard deduction threshold, this could be an opportunity, especially even for charitable giving. Between now and 2029, your donations may provide a bigger tax benefit than they will after the cap expires. But just like a lot of strategies, this one is highly going to be dependent on your income, your gifting plans, and how future tax law changes in the future. But that's kind of why you want to take advantage of these types of tax changes while they're around, right?
Yeah.
And that's why really, again, working with a financial advisor and really having your financial advisor even in communication with your CPA to work as a team is just so important to make confident and smart choices, don't you think?
Yeah, no kidding, Jenna. And that kind of reminds me, like building a financial strategy with a financial services professional and a tax professional is kind of like a powerful, like 1-2 punch, you know?
Oh, I like that. That is really good. I was watching Karate Kid last night, and it brings back just how powerful those punches can be, right?
Yeah, if you get them in the right spot and you have the right, armor and backup.
Oh, yeah, yeah, and the right coach, all that. So I
Yes.
love that. If any of our listeners do like to give to charity, and they, won't usually itemize your deduction, here's a bit of encouraging news. Under the current proposal, couples who take the standard deduction will still be able to deduct up to $2,000 in cash contributions to qualified charities. And that's a big deal for folks in their 50s, and especially, if they give smaller amounts. In the past, those gifts may not have reduced your tax bill, but now they could. And so if you're swiping a card or writing a check to your favorite cause, you can now really do that with a bit of a tax benefit. And so if that sounds familiar, it's because we saw a similar provision in the CARES Act back in 2020 and 2021. But for larger gifts, more advanced strategies like funding a trust or making donations over age 70 and a half, some financial advisors will still recommend like giving those appreciated stocks or qualified charitable distributions, which we've talked about in the past. One thing to watch for those who do itemize, there's now a 0.5% charitable giving hurdle, similar to how medical deductions work. And that means the first portion of your giving may not be deductible. So again, the standard deduction donors could actually come out ahead.
Yeah. I mean, just be smart about it, right? Come up with a plan and know your benefits going into it as well as coming out of it. How do you handle that? And how do you get taxes maybe better and, not as, so you come out on the positive side,
Exactly. Yes, yes. And let's take a moment to highlight something that had a big impact on our planning conversations. The tax cuts from the 2017 Tax Cut and Jobs Act, it was set to expire next year in January for individuals in 2026. And that wouldn't mean a return to higher marginal tax rates. But under the new legislation, those current personal tax breaks are staying in place. So the same tax brackets are staying in place permanently, which is wonderful. And while nothing in Washington is ever permanent, really, having clarity at least on next year's brackets gives us more confidence in our planning, right?
Mm-hmm. Absolutely.
And for many people, that means continuing to strategically convert to Roth IRAs. I mean, I don't know if you heard that, Jaclyn, but there was some rumblings around, well, are they going to take away the option to convert to Roth IRAs? That was really kind of a buzz going around. And the answer to that is no, they didn't. For many people, that means continuing, though, to strategically convert to Roth IRAs, which, depending on the situation, we're a huge fan of, especially up to the 24% bracket is smart. Now, it's not the right move for everybody, but it can be a great tool in some situations to reduce the required minimum distributions that you have coming out, which then in return could possibly reduce your Social Security income tax, and it could help you in the future. Now, the 24% bracket is really wide, and you may want to work with a financial advisor and CPA to take advantage of it before you hit the RMD age, which is 73 or 75, depending on your birth year. And so these proactive moves, like doing a Roth conversion, can really soften the tax hit later on in retirement,
Yeah. And I know, Jenna, you and I have also done a show about a traditional IRA versus Roth IRA. So,
yes,
our listeners and viewers can go back and find that video as well, because that does help, kind of understand the difference and what Jenna is truly saying in the situation. But anything else you want to add before we conclude today's episode?
Yeah, well, we've talked a lot about some of the changes in the big, beautiful tax bill. We talked about that senior deduction of $6,000 a person if you're married and file jointly $12,000. That is going to really potentially impact your taxes depending on your income. And we talked about some charitable giving, some Roth conversion opportunities. We talked about just how this big, beautiful tax bill, some of the big changes that can come into play. And for a lot of people, it really will help reduce their Social Security. But like I said earlier, we've also got to think about the long-term impact of Social Security and make sure that continues to get funded properly. So it's so important. I can't share this enough, to have a financial advisor that really keeps you on the cutting edge of what's going on. I mean, wouldn't you say, Jaclyn, are quite a few big tax changes that people could really take advantage of right now for their financial planning.
Absolutely. And even for me, even doing these episodes with you, Jenna, I mean, my brain is just full trying to think about all of this and trying to keep it all straight. And I know you are so knowledgeable in this. I mean, you have these numbers on the top of your head, the exact information. I mean, you know this to a T. And so, how can our listeners and our viewers get a hold of you to schedule a complimentary financial consultation with you?
Yes, well, it is so important to give us a call and to be working with a financial advisor that's communicating these changes with you
Mhm.
and really keeping you on the cutting edge of all these tax law legislation changes. I mean, one change in the tax law could make a huge impact in your financial future. And if you don't know about that, that's an issue. So people can get a hold of us at 1-800-994-8993 or email us to schedule a consultation at info@beaconwealthadvisory.com. So thank you everybody for joining us. And Jaclyn, you want to close us out?
I will. Thank you, Jenna. And that concludes another episode of Retirement Today with Jenna Cairns from Beacon Wealth Advisory and me, Jaclyn Gladhill, your co host. And we will see you guys next week.